Abhizar Divanji is with us, founder at NeoStrat Advisor. Abhizar, thank you for your patience. Just trying to break down and understand exactly what has happened. How do you see this development? Does this prima facie seem like a governance lapse, an oversight, or something perhaps more disturbing beneath the surface? And that's really the question that the street is wondering about.
No, clearly there is a regulation lapse for sure. I'm not sure it's a governance lapse, but it's certainly a regulation lapse because as Vishy just explained, when the RBI circular came in, RBI basically said you cannot hold open positions in foreign currency assets that you take and you have to hedge them. And rightly so, if you hedge them, you would not have an issue. Now look at the interesting problem. Either is it an oversight or is it a conscious management decision not to hedge and make some money out of a dollar position? Is the question that I guess the bank's management would have taken a decision in contravention to the regulation. So leave the regulation out for 2 minutes. The bank would have expected that if I have a position, and assuming this is all known and this is not something that was inadvertent, the bank would have said, yes, I'm holding a position and trying to unwind it. And of course, the 2023 circular kind of was not followed, would have been. In return to that, what happened is that we had a massive tumble of the dollar in the last 1 year. And that clearly has impacted or triggered the mark to market situation. And so it's a bet which has gone wrong if you leave the regulation aside. Now coming to the regulation lapse, whether it is a error on the part of the bank's management and the external agency will decide who the error was on, or whether it is a conscious open position taken by the bank in contravention of the 2003 regulation is always going to be a debatable issue, which I don't think will get resolved.
Mr. Vanji Vishwanath, the question, while regulation and regulatory sort of lapse, how does one look at it and say that, oh, this is regulatory and this is not governance? I mean, is that even a definitive decision that you can take sitting outside the bank? People inside the bank are probably better placed.
Governance is if nobody knows what happened to that exposure and because of which the bank may end up losing 1,200 crores. That is a governance issue. That somebody just did not know what was happening. The other issue is a regulation lapse to say that I knew a regulation existed. I knew that there was a position in the bank and that position was consciously held because I thought the dollar would move the other way. Basically.
So bad math.
So that's how I would differentiate between the two. What is right and what is wrong are again two different issues. But what I would very consciously want to say is that either which way it's a regulation lapse for sure. The governance lapse I think is a slightly bigger issue. That if one does not know what is happening in the bank, and that can be linked to the fact that, oh, does a CEO get a 1-year term or a 3-year term? So I'm just trying to, kind of combine both these things and say that, yes, banks which are currently trying to deal with profitability, some of them may have taken those decisions within their ambit. Some of them may have been, taken to say that this is a currency position I wish to take over a period of time. And there's an RBI circular which is ultra conservative in a sense that it requires every position to be hedged. And it basically tells the bank not to take any foreign exchange exposures, which may or may not be a correct regulation, but at the end of the day, it's a regulation. The problem is the differentiation we need to make is whether it is a lapse, as in a management lapse, oh, I did not know the circular, or I knew the circular, but I wanted to take a conscious move.
Let me also ask you, obviously this is not a one bank problem, or at least I don't see it that way. Likely that you have skeletons hidden somewhere else as well.
Possible. See, I mean, that's always been the dilemma of the regulator, right? I mean, it happened in the Kotak case, it happened in the HDFC case and every other case. When one credit card fault was picked up, others went and capitalized on it. And it's not that the other banks may not have had that problem. So yeah, it's, where the regulator catches the goose is the one which faces the heat.
Neeraj JR, good morning. Do you reckon that, an incident makes the regulator even more watchful, right? We've seen that in microfinance, in a clutch of other things. Do you suspect or do you hypothesize increased regulator scrutiny for a lot of banks which might have, similar traits in terms of higher NRI deposits or what have you, happening in the next few months?
Oh yeah, absolutely. See, the regulator is extremely vigilant and careful now because of the way the system is. The banking system is under severe profitability issues because clearly corporate is not fired and will not fire. Retail is firing but lacking. Things like microfinance are kind of hitting the roof. So we are facing an economy which is going to impact the banking sector first, because clearly that is the the loans are the repository of where the stress lies. So I think as and when the stress comes up, banks are going to look at alternative ways of figuring out what they can do. So the vulnerable banks, especially the mid-sized banks and the lower-sized banks, are the ones which are going to be under excessive scrutiny, and rightly so.
Okay. Okay, Abhijit Diwanji, this was important getting your views this morning. Thank you so much for taking the time out and being with us and explaining that.